Ladies and gentlemen, welcome back to the channel. Let's talk about why AMC stock is the most expensive stock for short sellers to borrow. Yeah, that's this article. Now, next week, you're going to have something interesting happening. I've talked about this before, but it's the portfolio rebalancing. I have all of the final weightings for you and the changes that are going to be taking place. Now, this could put some downside pressure on big tech. There's something strange about this portfolio rebalancing that could be good news for you if you're hoping for the AMC short squeeze. Now, let's go ahead and get into all of this information. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. So, first things first, what's happening on the day? Well, not too much. People are still digesting and reacting to the earnings that we have seen this week. Some of your bigger tech names are falling today. Microsoft is down about 1%. Apple is down 1/3%. The Nasdaq is down 0.21%. And the S&P is hardly in the green today. To some extent, you have seen a shift in where people are investing their money in stocks such as Microsoft. They're getting sold off your other big tech names. Part of this could be having something to do with the rebalancing that we are going to be seeing next week, and part of it is just because those stocks are grossly overvalued. Quite literally, grossly overvalued. AMC stock is up about 1% at the time of recording this video, and it looks like a short squeeze could be imminent whenever the judge finally decides to wake up and make her decision. I don't know who's faster, the judge or our president. Now, let's go ahead and get into some of the raw data that you need to know here on the day today. Short score of 96. Highest it's ever been, by far. $626 million worth of short positions currently on AMC stock. Estimated short interest of free float, 28%. Free float out on loan, 34.4%. Shares out on loan, 177.63 million. Days to cover. This is one of the most bullish things currently happening for AMC stock, sitting at 10.22. Cost to borrow fees, 281% over the last 3 months. And utilization sitting at about 85%. This is likely because some of the selling of especially APE is getting picked up by Ortex and grouping that into AMC as a whole. Now, last we knew, the actual short interest was around 29%. This could be higher, as I've talked about before, if APE still owns a vast majority of the float. You have 144 million shares currently sold short. Do the math, that's over 100% actual short interest of free float. Now, if we take a look at the cost to borrow fees, in which we're going to talk about here in this article as well, cost to borrow average 985%, cost to borrow max 1050%, cost to borrow minimum 971%. Interactive Brokers has cost to borrow fees of 1000% here today. These are numbers that hedge funds institutions did not plan on paying for months and months and months. Now, this article says why AMC stock is the most expensive stock for short sellers to borrow. Traders willing to bet against AMC must pay the highest borrowing fees in the market. Is it worth it? The high borrow fees are a result of heavy short selling activity in AMC stock in recent years and arbitrage trades involving AMC's preferred shares, the APE units. Although an arbitrage trade that involves shorting AMC and going long APE makes complete sense, AMC's volatile nature and sky-high borrow fees might not make the trade worth it. Out of all the publicly listed companies on the U.S. Stock Exchange, none of them currently outperforms movie theater chain AMC's when it comes to cost to borrow. These are the fees that brokerages charge traders for borrowing a security in order to short, bet against a stock. Traders must first borrow shares of the underlying security. The second highest is Alpine Summit Energy Partners and Saver One, 600%, Advanced Human Imaging, as well as Mango Ceuticals. Like, none of these companies you've ever even heard of. But AMC, they are by far the most expensive stock to borrow right now. The forces of supply and demand usually determine borrow fee rates. When there is high demand to short a stock but few shares available to borrow, fees rise. AMC has been the target of heavy short selling in recent years. Its borrow fees have reached higher than an incredible 1,000% on an annualized basis, implying that this is a very risky stock for short sellers. AMC stock has been unusually volatile in the past 2 years thanks to the meme stock frenzy that has sent shares on incredible rallies. That has attracted short sellers to stocks like bees to honey. In addition, some traders have been engaging in an arbitrage trade involving the stock and APE units. Ever since the apes began trading, there has been a nonsensical difference in the price between the common stock and preferred shares. AMC currently trades at about $4.30 per share, while ape is roughly at $1.90. Both securities have the same voting and economic rights and represent the same business. There's no logical reason why there should be such a price difference. Arbitrage traders have been betting that the two stocks will eventually converge in terms of price. They're shorting AMC while going long ape. Interest in the arbitrage trade grew after AMC's management announced its plan to convert the apes into common shares. At a shareholder meeting, AMC's investors approved the conversion proposal, which would allow the movie theater chain to raise a sizable cash position. But thanks to a class action lawsuit, the execution of the conversion has been temporarily blocked. A court hearing on a proposed settlement that would allow the conversion to go ahead was held at the end of June. The judge's decision is expected within the next few weeks. In the meantime, the soap opera surrounding ape conversion has been a main driver of AMC stock performance. There has been a growing interest from short sellers who believe that the spread between the two equities will soon vanish, and that the subsequent dilution of AMC will have a bearish effect on its stock price. All of this has spurred demand to short AMC stock, which in turn has driven up its borrow fees. Does the arbitrage trade make sense? On the surface, the AMC arbitrage trade makes total sense. Once the courts give the green light to the conversion, and there's little doubt that this will not happen, AMC shares will likely fall while the apes will rise. However, considering AMC's volatile nature and borrow fees exceeding 1,000%, this trade is not without significant risk. High borrow fees can make keeping such a position open for an extended period of time extremely expensive. In addition, if AMC shares were to suddenly see a significant rise in price, those shorting the stock may face substantial losses. Therefore, the arbitrage trade, which in theory should be a sure thing, is a surprisingly risky play. And again, I'm kind of disappointed he did not highlight AMC raising billions and billions of dollars of capital. That's bullish no matter which way you put it. So it's not like this arbitrage trade, this situation is a hands down bearish for AMC. That's not necessarily the case. When you're raising billions of dollars of capital, that surprisingly can be a pretty bullish event, which shouldn't be too surprising to all of you guys. Now, if we take a look at the option activity, I think this gives us a clear picture of what he means by a short seller trying to short the stock like bees to honey, right? You've never been this short in AMC, for one, throughout this whole trade. You've never had the days to cover being so high. You've never had so many things look so squeezable. Cost of borrow fees at 1,000% at the same time all of this is happening. This is unprecedented. You are in uncharted waters here. Now, the put to call ratio is also exceptionally bearish. Everyone's bearish. Everyone and their mom and your brother and your aunt, your cousin, uncle, everyone's bearish. Now, they're not bearish because the stock is high, which typically that's what leads shorts to take on a lot of short positions. Quite the opposite. The stock is sitting at some of the lowest levels that's been at in years, but the put to call ratio is so high. This is because everyone is betting that this arbitrage trade alone, regardless of the huge positive that comes out of it, will be a massive negative for AMC stock. I'm not convinced of that. I think we've had long enough to price this in. I don't expect this to be a huge negative thing once it happens. After all, it's not going to be new information. We're just going to finally get the ending of what we've known is happening for a long time now. Now, as far as the option activity today, you have seen 40 orders totaling about $19.2 million with a positive order value of 0%. 0%. Nobody is looking to take a long position in AMC as of right now, which I think is just really flawed, especially if you're going to take a long position. The options look very, very attractive as of right now. So there you have it. Markets are selling off into the close. This is probably because you have a $2.4 trillion option expiration today. You're seeing the most option activity you've seen in a long time on really every stock, as well as the indexes. Now, this is $2.4 trillion expiring on top of the Nasdaq 100 rebalancing, and it may cause volatility. We've talked about this before. The Nasdaq has done this twice. Back in May of 2011, 3 months later, the Nasdaq fell 20%. Back in 1998, 5 months later, Nasdaq fell about 20%. Well, here is the weightings of these stocks, these big tech stocks, and where they will go. So Apple will be reduced from 12.06% to 11.05%, seeing one of the smallest reductions. Microsoft, seeing one of the largest reductions, will be reduced from 12.74% to 9.8%. That's a big drop, and that's probably why Microsoft is down almost 1.5% at the time of recording this video. Now, Alphabet, Google, will be dropped from 7.61% to 5.7%, Amazon from 6.91% to 5.3%, Nvidia from 7.28% to 4.3%. Nvidia and Microsoft are really getting theirs reduced. Meta from 4.46% to 3.7%, and Tesla from 4.44% to 3.4%. Now, why this is kind of strange is because this rebalancing happens Monday. So first day of trading next week, boom, rebalancing will be done. Now, this likely means a selling of a lot of these stocks, especially Microsoft and Nvidia. These stocks are sitting at the highs, right? Basically the highs of their cycle. But why this is really interesting, and what some analysts, I've heard one analyst say this on CNBC, but I think it's very much what you should be thinking about. Microsoft reports earnings on Tuesday, and they're doing this rebalancing on Monday. Maybe that's just bad timing, coincidental timing, but that just doesn't look good, right? Nonetheless, needless to say, that just doesn't sound good. So we'll see. Microsoft is seeing its reduction drop the most, as well as Nvidia, about 3% for both of them. So maybe it's a sign of bad earnings to come. Ultimately, we'll have to see. But if big tech does fall, that could be a very positive development for AMC as far as squeezing out liquidity in this market. That's the main reason why shorts have not had to cover in times in the past, because AMC was squeezing when everything was doing very well. As you see today, big tech is falling and AMC is up about 1.5%. Probably a reason for this. So ultimately, none of this really matters in the grand scope of things. We're waiting on the courts. That's going to be the big catalyst for AMC. But I did want to bring you this information because hopefully you found it helpful or insightful. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with me live in real time, I made some trades today. Link down below in the description of this video. You guys enjoy the rest of your day, and I will see you in the next one.